Let's talk about the basics of options and why they have a useful place in today's market. An option is a contract you can buy or sell that gives the owner the right but not the obligation to buy or sell a stock at a specific price at or before an agreed upon date. This all may sound confusing at first, but we'll go over some examples soon and it will all start to form a clearer picture. There are two types of options that can be traded: call options and put options. Call options give the options owner the right but not the obligation to buy 100 shares of a stock at an agreed upon price on or before a particular date. Put options are the opposite due to the options owner having the right to sell 100 shares of a stock at an agreed upon price on or before a particular date. This magical number that is the agreed upon price is known as the strike price. The agreed upon date which the contract expires on is the expiration date. The option must be used before or on this date and cannot be used after this date is passed. With the definitions out of the way, let's get into why you'd want to buy these options and how they can cause you to gain or lose money. Why would you want to buy a call option? You'd want to buy a call option if you believe a stock will rise and want exposure to the upward movement of 100 shares of that stock at a lower price without having to purchase the stock itself. This allows you to leverage your returns when compared to just owning the stock. Still confused? Let's go over a real-world example. Here we have an imaginary stock with a ticker symbol STCK. Let's say STCK is currently trading at $50. We hypothesize that it will rise to $55 in price within the next 30 days, so we decide to purchase a $55 call option. We purchase this contract for $1 per share times the 100 shares the contract represents for a total cost of $100. The $1 price per share for the option contract was agreed upon between yourself and the seller, who is now agreeing to sell you 100 shares of STCK at $55 each at any point over the next 30 days. Now there are three possible scenarios for this option we must account for. The first scenario is if the price was to rise to $60, which is above $55 like we predicted, within the next 30 days. In this instance, we could exercise the contract, allowing us to buy 100 shares of the stock at $55 each for a total cost of $5,500, and sell them immediately for $6,000 total, netting you a $500 net gain. It's important to subtract your initial price you paid for the option of $100 however, so your total profit is really $400. This isn't bad at all, and you would be up 400% for buying this option, whereas the underlying stock went up 20% during the same time period. This shows how you can increase your gains by buying call options on a stock. The second scenario is if the price were to stay below our strike price of $55 by the time of expiration. In this instance, we have a contract that allows us to buy the stock for $55 even though the stock is worth less than this. We would never want to use this contract because we would end up paying more than the stock is currently worth. So this is called expiring worthless, since the option now has no value, losing your initial investment and nothing more. So your max loss for this call option is $100, meaning you can only lose up to what you pay for the call option. The last scenario is if the price of the stock is at $56 at the time of expiration. In this instance, you could buy 100 shares at a cost of $5,500 and then sell them at $5,600 for a $100 profit, but then you must subtract the $100 you paid for the contract, making your effective gain zero. In this scenario, $56 is what is known as the break-even price, where you don't gain or lose money. What if you don't have $5,500 lying around to buy the stock at expiration? This is no big deal, as you can also sell the contract to someone else. It is a law that the option must be sold for at least the value you could gain from using it. This allows you to make the same profit as all the previously listed scenarios by selling the contract to someone else versus using it for yourself, meaning you'd only need $100 to perform this trade. It's important to note you can also sell this option before expiration, but the math on that is a little different, and we'll go over that in a future video. Call options are great and all, but what about a put? Remember, a put is the opposite of a call, allowing you to sell 100 shares of a stock at a fixed price at or before an agreed upon date. You want to buy a put if you believe the stock will drop below your strike price by a certain date, or if you want downside protection for shares that you own, limiting your losses. Let's reuse the same stock from the call example named STCK, still priced at $50. If you suspect that STCK will drop below $45 over the next 30 days, you can buy a put option at a $45 strike price. Let's use the same cost of $1 per share of the contract, which would come out to $100 total, since one contract represents 100 shares. Let's look at a few scenarios and what their benefits or cons would be. In the first scenario, STCK did what you expected and drops to $40 before the contract expires, which is below your strike price of $45. If this were to happen and we owned 100 shares, we could exercise this contract, allowing us to sell our 100 shares at the strike price of $45 a share, preventing us from losing an extra $500 from the stock dropping to $40. Similarly to a call option, however, you can purchase a put without owning the underlying stock. If this was the case, you could sell your put option for the value it would give to the person buying it, which in this instance would be $5 a share. By selling this contract, we can get $500 since it's $5 per share times 100 shares. By subtracting our total cost of $100 we bought the contract for, we end up with a profit of $400 or 400% because the stock dropped 20%. This shows why buying a put option can be a profitable strategy for when the stock is dropping, allowing you to make money in a bear market. The second scenario is if the stock were to stay above $45. Similar to the call option example, you would not want to use your option in this case, as you have a contract to sell a stock at a price worth less than it is currently valued at, which would be a net loss for you. This is because we could sell it for $45, but it's worth more than it. So if it was, for instance, $46, we could sell it for $45 when if we just sold it on the open market, we could get $46 for it. So we would never want to use this because it would be a net loss for us. With this in mind, this contract is considered worthless, meaning you would lose 100% of your initial investment of $100 and nothing more. So your max loss on this contract is $100. The final instance is if the price at expiration was exactly $44. Similarly to call options, this would be the break-even price since your value and cost cancel each other out. This is because your contract allows you to sell at $45 when the stock is currently trading at $44, netting you a net profit of $1 per share times 100 shares, since that's what your contract is for $100. But your overall cost was $100 to buy this option, so your net gain is $0 total, meaning you do not lose or gain money off of purchasing this contract. When you're thinking about purchasing an options contract, it is important to keep these values like the strike price and break-even price in mind, as they are incredibly important for figuring out whether your trade will be profitable or not, given your thesis on where the stock's price will move. Generally speaking, picking a strike price that is closer to the current price of the stock increases your chances of the stock reaching that price. This in turn increases your chances of the options contract becoming profitable for you, and decreases the chance of it moving unfavorably too far where you would begin to lose your money. You can even set your strike price so it's what's known as in the money, meaning a call strike that is below your current trading price or a put strike that is above the current trading price. This in turn increases your chances of profitability even higher. Where to buy is complicated and will be covered more in future videos. Overall, a call option allows you to benefit from the upward movement of a stock, and a put option allows you to benefit from its decrease. In the future, we'll be covering all things related to options trading, stocks, and general business, so consider clicking subscribe to join our ever-growing community. Thank you for watching.